financial support of viewers like you. By The Travelers, the company that helps provide financial peace of mind for over 40 million Americans. And by Prudential Bache Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. Produced Friday, February 2. Our panelists are William Gross, Bernadette Murphy, and Carter Randall. Tonight's special guest is Robert S. Robbins, market strategist, Robinson Humphrey Company.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, this was the week when George Bush was upbeat about the State of the Union. And Mikhail Gorbachev had increasing reasons for concern about the union of his state. With freedom breaking out from Pinsk to Prague to Pretoria, Bush was at his most relaxed and confident, clearly enjoying in every pore the revenge of the wimps. Why, this week he even had an assist from his country's economic czar, Federal Reserve Chairman Alan Greenspan, who allowed with uncharacteristic precision that the odds were at least 4-to-1 against any U.S. recession in the next 6 months. Though he added, in a brief return to his customary caution, that he wouldn't want to bet the ranch on such predictions, Greenspan's optimism was just what the doctor ordered for a president whose own positive forecasts for the economy were widely viewed in Congress as the latest bestseller from that prominent writer of Washington romantic fiction, Ms. Rosy Scenario. Not that the economy was moving as fast as political events around the globe. Sales of new family homes were dismal, for example, and consumer confidence hasn't been this low since right after the 1987 panic on Wall Street. But despite further weakness in manufacturing employment, jobs generally continued to grow, and the overall unemployment rate actually dipped a notch. In short, the week suggested that reports of the death of the 7-year economic expansion were again premature. And there were even some signs, such as a pickup in construction contracts, that things may be notably stronger later in the year. While that would be good news for businesses, workers, and other living things, it does not portend the rapid descent in interest rates on which many investors have been counting. Nonetheless, the stock and bond markets apparently decided that enough was enough, at least for now, and both ended their recent strings of weekly declines, 3 straight for stocks, 6 straight for bonds. The rebounds, to be sure, were less than euphoric, and both markets were sagging notably in the closing hours of trading, but stock traders took some comfort in the fact that their market could not penetrate the panic lows set as recently as this past October, at least not this week. This was, after all, Groundhog Day. And if Wall Street saw the shadow of January, in which the Dow lost nearly 163 points, it could be a cold winter yet to come, which by itself might be reason enough for us to turn south tonight for a talk with my special guest, who is one of the leading analysts in Dixie. But first, let's see what took the chill off in Wall Street in the week just past. The Dow Jones Industrial Average scrambled back above the 2,600 mark, though just barely, and is still more than 200 points below the record it established on the first trading day of the year. But the blue chip index did manage to score its best weekly gain in 2 months, up about 43.5 points to 2602.70. The broader averages all ended in the plus column as well, with the energy-heavy American Exchange Index following 13 straight losing days with 3 consecutive advances. No change from our usually volatile elves, though. The consensus of our 10 leading technical market analysts remains a bearish -3 on the next 3 to 6 months. Gold and silver again stalled out, while it was another losing week for the dollar. 3 items on the brighter side. The undersized U.S. savings rate, which hit a 40-year bottom at 3.2% in 1987, snapped back to 5.5% last year. The Congressional Budget Office, a less likely source than the White House of rosy scenarios, said it expected 1990 to see lower interest rates and stable inflation with no recession. And nicest of all, this week is the 40th anniversary of Charlie Brown and the Peanuts gang. Good grief, Bernadette Murphy. What's the next adventure for this market?
Well, I think the next adventure is still an upward bias. The market became extremely oversold. We're at bearish readings we haven't seen since November 1988, before the 1989 advance began. And we have, at this point, 85% of the New York Stock Exchange stocks trading below their 10-week moving averages. That's an oversold condition. It doesn't change the trend, I don't think.
Yeah, you are one of the negative
Yes,
elves,
I'm one of the bears.
But you expect in the next few days a little bounce, but then continued downtrend, is that correct?
Yes, I think we could go up close to 2,700 before this rally tires out.
What are the basic negatives that impel you to be pessimistic?
It actually began last August when the market started losing momentum and we started having a shrinking in the new high list. Volume began to decline. But what really disturbed me was the week of January 19th when the breadth of the number of issues participating, which had been holding at a low level, broke down again. And then the following Monday, we had the New York Composite and the S&P 500 break below their November 6th lows. And they clearly broke their 200-day moving averages. And to me, that was a very dangerous sign.
Carter Randall, Bernadette says technically there is still a great deal of weakness in this market. I know you don't pay too much attention to technical indicators. What do you think fundamentally?
Well, fundamentally, I come to almost the same conclusion, but I'm looking at confidence of people rather than the technical factors. I think people haven't lost confidence, but they're certainly not overconfident, and there's too much uncertainty, there's too much bad economic news, real estate, or the automobile industry, et cetera, and that something has to happen to bring confidence back into the market, to have a strong market. I don't think it's happening right now.
Carter, you touched on real estate. It's of interest to practically everybody in the country. What do you think's the outlook for real estate now?
Well, I think there's no question that the outlook for real estate is pretty poor. We're seeing literally thousands, hundreds of thousands of properties coming for sale because of the demise of the S&L industry. And commercial building is overbuilt. And I think real estate is having problems. There's a ripple effect on that equity towards the stock market equity. Now, I'm not looking for a bad market, don't misunderstand me, but I think we're in a pause period here.
Well, if you've given us a lot of bad news, why are you not looking for a bad market?
Well, because I think earnings overall are holding up pretty well. And I think inflation will start to abate this year, and I don't care what Mr. Greenspan says, he's going to ease money as this year goes by.
He didn't say he wouldn't.
I know, and we're looking at a better economy in 1991, which the stock market will begin to anticipate.
Bill Gross, you got the casting vote. What do you think?
I think the market is headed lower, Lou. I think the combination of higher interest rates and lower corporate profits, in deference to what Carter just said, means a lower market. We've got 0 to 2%.
Well, Carter didn't say they wouldn't be lower. He just said they were holding up reasonably well. You think they'll be hit worse than that?
0 to 2% economic growth, to my way of thinking, in terms of historic trends, suggests that corporate profits are going nowhere and perhaps down. We really need a 3% GNP number over a period of quarters to be very optimistic on corporate profits. And I think if interest rates stay at these levels, then the market's going lower.
Most of your investment activity is in the bond area. Are we going to see those lower interest rates?
Eventually, but domestic rates these days, as you've mentioned in your past few programs, are dependent to a significant extent on the foreign markets. We need Japan and we need Germany to send their markets lower, and that may take several months, perhaps several quarters. Japan still has strong economic growth, and in order to lower interest rates, they're going to have to tighten the strings perhaps a little bit more.
More trouble ahead for the bond market then?
Well, I think just a little bit. At 8.5% today in terms of Treasury rates, we're discounting a lot of tightness on the part of foreign central banks. And I think we're at a level where foreign lenders will participate in future refundings. I think there's value in the market. So if you've got some money, start to put some into the market, especially into some single A and perhaps BAA corporate bonds, which are yielding 10.5 to 11%.
All righty. In any event, panelists, it's time to keep our viewers from seeing the shadow of poverty. Bernadette Murphy, Howard Katz of Pittsburgh wants to know whether it is true that institutional program traders, the guys who buy and sell huge bundles of stocks at the flicker of a computer readout, are not subject, like everybody else, to the so-called uptick rule, which forbids selling a stock short while its price is declining. If this is true, he asks, how long has the exception been in place, and wouldn't ending it make it harder for program traders to drive the market down rapidly?
Program traders are not exempt from the uptick rule. Therefore, when they go bearish on the market, they'll most often sell futures or stock derivatives, index derivatives in the market. The big pressure on the market comes when their long stock positions are judged to be expensive relative to the available future or derivative, and they therefore sell or unwind those stock positions. In December 1986, the SEC did issue a no-action letter, but it gave traders the right, when evaluating the aggregate net securities of the firm in its own accounts, the right to treat fully hedged positions as a zero. But it did not exempt them from the uptick rule.
But it gives them an edge that the individual doesn't have, does it not?
I don't think, you mean on that no-action letter?
Yes.
On the no-action letter, if the firm in its aggregate accounts is long stocks that they want to sell, they can sell them long, not on the uptick, but only once.
Okay, Carter Randall, Earl Blau of Mission, Texas, would like your view on what could cause a major fall in the Japanese stock market and what the consequences of such a fall would be for the U.S. stock and bond markets.
Well, the thing that would cause would be more selling than buying. No, seriously, Lou.
More selling than buying.
More selling than buying.
Or more enthusiastic sellers.
Exactly. No, of course, like any other market, the Japanese market could decline if it looks as if the economy there is slowing down, if the earnings don't hold up. It is a very highly priced market. I'm not looking for a major decline in the Japanese market, but if we had one, sure, there would be a ripple effect all over the world. Major markets have ripple effects with each other, but it would depend on the reason for the decline, and there's so many things that can make any market go down.
Bill Gross, how would you respond to Robert Seiler of Jefferson City, Missouri, who writes as follows: with all the push these days for more daycare facilities for children, is there any company or franchise in this field worth investigating?
That's the perfect question for me, Lou. It's the first chance I've had since high school to use my German and French at the same time. The two major companies in this business are Kindercare, that's the German.
Glad you pointed that out.
La Petite Académie, that's the French. Both of these companies, however, have negative opinions from my standpoint. La Petite Académie has had static earnings for a number of years and carries a 20 PE. Kindercare has an 80% debt ratio and is almost akin to an LBO. So I would avoid both of these stocks at the moment. They're both on the over-the-counter in case your listeners would want to check them out. But best to wait for a Japanese stock in this area. I might not be able to pronounce it, but in any case, it might be more successful.
Pleasure to have a cultured linguist on our staff. Okay, now if you are looking for investments that will grow as fast as your children, or at least reach a satisfactory maturity, these kids would love to play with your problem. For care of the most tender, loving variety, keep your children, but send your money questions to us here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, who holds the unfashionable view that the Wall Street worrywarts are wrong again, and that the Dow Jones Industrials will soar to 5,000 by the end of 1995, let's see why he believes that the prospect of lower inflation in the economy should lead stockholders to greatly inflated expectations. Fears of higher inflation are always bad for stocks, he says, noting that in the period surrounding World War I, consumer prices more than doubled, while the Dow went up barely more than 15%. But when consumer prices started falling after the middle of 1920, investors took heart, and the Dow skyrocketed by 273% before it crashed in late 1929. Similarly, when inflation returned after World War II and during the Korean War, stocks couldn't keep up. But when the trend reversed and inflation was tamed, consumer prices rose a total of only about 20% in 14 years, delighted stock investors sparked a 237% rally. The most recent generation has seen a similar two-part story. When consumer prices more than tripled from June 1966 to August 1982, stocks looked like poison, and the Dow gained barely 1%. But since then, with consumer prices moving up much more slowly by just 29% in 7.5 years, stocks again looked attractive, and the Dow soared by nearly 222%. So it really all depends on A, whether you believe that changes in inflationary expectations were the real reasons for these market changes, and B, whether you think we're truly going to get lower inflation in the 90s. For some thoughts on these and other fast-rising questions, let's go over now and meet tonight's special guest, Robert S. Robbins. Bob, welcome.
Lou, it's great to be here.
Glad you could come up. Robert Robbins is a native Tennessean who went from Dartmouth College, from which he graduated in 1969, straight into the Army as a combat lieutenant, and then really showing courage into Wall Street. He's worked for 2 banks and 2 brokers since 1986 for Robinson Humphrey in Atlanta, gaining a reputation as one of the strongest voices in the Southeast on market strategy and technical analysis. Bob, it's always nice to hear a cheerful voice amid the gloom, especially after hearing some more of it just now. But I did notice that as recently as December 27th, you had been predicting 2850 on the Dow by the end of January and 3,000 by the end of March. So is spring actually going to be a little late this year?
It looks that way. It looks like it could be a summer rally that we'll be looking for. We saw most all of the rally we were looking from the early November point, and we got the year-end rally almost to our 2850 objective. Then some things started going wrong that are awfully difficult to forecast, and we got some pressure from interest rates in Japan. We got the Moynihan proposal, which disturbed things. We got a little more news of stagflation, so it looks like we're going to have to work through this a few months and look out further later in the year.
Why should the market be disturbed by the Moynihan proposal to cut Social Security taxes?
Well, simply because it's so difficult for the government to control spending. It's much easier and politically popular to cut taxes. And we've seen government spending tend to cause inflation, which is the big problem that we've cited.
Looking back at that graphic we've just given, I understand your theory, but we're not now seeing a reversal. We're seeing a continuation of the trend of the 80s of less inflation, by your reasoning. Is that not correct?
I think that's right.
So why should we have a reversal to much higher stock prices? You just mean we'll see a continuation of what we've seen in recent years. Is that correct?
Well, I think long-term we're on track. Short-term we do have a little bit of inflation concern. Long-term, I think we are winding down inflation expectations to closer to the 3% norm of the century. If we do that, that's about a 1/3 improvement from about the 4.5% inflation expectations now, and that would have a tremendous positive effect for stock and bond prices.
We've just heard some concern expressed about corporate profits. What's your feeling there?
I think corporate profits really aren't the key focus for the long-term investor now. It's typical in the best bull markets of this century to see corporate profits growing rather sluggishly, often with this kind of stagflation setback. The key thing to watch is whether inflation is being brought down without an economic recession. As long as that continues to happen, then I think we can continue a super bull stock market.
As a good technician, you look at the short run as well as the long. Tell us what you expect for the short run, tell us what the short run is, and tell us what you expect for the long run.
Well, for the next perhaps 3 months, I think the market's probably in a trading range, 24.75 to maybe 26.50. So I wouldn't chase this rally that we've seen in the last couple of days. We've had the worst technical deterioration of the stock and bond markets since the crash of '87. So even though I'm very bullish long term, we've got to respect the risks here. We've got to respect the unknown variables coming from Japan. So I'd say be defensive now, 40% invested for short-term aggressive investors, 65% for long-term oriented investors. Wait till the outlook clears a bit, both technically and fundamentally.
And where would that 40% or 65% be?
Well, we're looking at a lot of special situations in the Southeast. That's our bread and butter work. We'd look at a few themes there. One is demographics. Our key play there would be Home Depot. We think nesting baby boomers, spending more time at home, fixing things up, will continue to grow their sales and earnings very nicely. We'd also look at a play like Interface, Inc., which is a play on global trade, a freedom play, development of Europe, perhaps Eastern Europe, continued growth in the Far East. Technology, productivity, Intergraph. Intergraph has been the most successful OTC technology firm in the Southeast, a new product cycle, earnings momentum.
Are these stocks relatively thinly traded?
No, actually, they're not too thinly traded. They are, one is in the secondary area. Interface is a little thin, so it's worth taking some caution right there. But the secondaries have been the best place to be long term. The investor since 1925 has gotten 3.5 times as much wealth investing in the secondaries versus the big stocks. Intergraph and Home Depot are both S&P 500 companies, so they trade very actively.
Let me turn you over to three blue chips, starting with Bernadette Murphy.
I'm glad to hear you're bullish on the secondaries. You haven't mentioned any consumer stocks, and I think that's an area of debate among investors, whether to stay with consumer stocks or whether to liquidate consumer stocks. What's your feeling on them?
I think consumer stocks are going to be okay, but I do think they are taking a little bit of a back seat as this economic cycle matures. I think we've got to say that the disinflation tendencies aren't quite so strong and aren't quite so beneficial to the consumer. But I think, yes, we're going to see a continued broad strength long-term, I think, in the stock market. And the consumer area is the heart of the economy. It's continuing to participate in the longest peacetime expansion in U.S. history. I think it'll do well.
Bob, I know you follow a lot of things, among which is gold itself. When people worry, they tend to buy gold. What do you say about gold at the moment?
I think gold is really a pure play on rising inflation long term. Short term, you can have some bobbling around with that. Long term, I wouldn't own gold because I think the trend is so well established to continue to fight inflation through more restrained fiscal policy and more restrained monetary policy. I think the recent run-up in gold may continue to $500, but I look at it as more of a trading play, and compared against stocks and bonds, you're underperforming very badly with no dividend return and no interest coupon.
Bob, they used to say that when the U.S. sneezes, the rest of the world catches cold. Now it seems that the reverse may be true. If so, how could the economies of the rest of the world affect our U.S. markets?
Well, I don't think that the foreign economies are quite so closely tied to ours. We're seeing a diversification of world economic growth. Japan has risen to be a great world power. Europe, I think, is on its way towards being, right on par there. The Soviet Union has slipped some relatively. I think we've got lots of bases of strength, lots of diversification, perhaps more stability to the world economic growth as a result of this diversification. So I'm actually pleased with what I see there, and I think I'm pleased with the general tendencies toward deregulation that we see that will continue to foster, I think, better world economic growth.
Bob, you've told us that you think that we'll have a trading range for 3 months, but very strong long-term gains. What will be your signal that we're taking off toward the happy hunting ground?
Well, I think we need to see some improvement in the interest rate outlook, some stabilization in the inflation pressures from Japan. I think we just need to see some repair of the technical deterioration of the stock and bond markets. We need to see some sort of bottoming action by the price pattern in the stock market.
What does that mean? More fear, more panic?
Well, we'll probably need to go back towards the lows, which will constitute a little bit more fear. We need to have just a little bit more of a sentiment.
Which lows are we talking about? Last week's?
The last week's lows at about 25.40. We've gotten a lot of bearishness out there. There's about 20% more bears than bulls, according to the surveys. So this is heartening, and it tends to refuel the buying power that's needed for the next advance. So I think we're a lot of the way there, a little further to go.
Since you talk about interest rates, let's focus on them for a second. What do you expect to happen to long-term and short-term rates this year?
Long-term Treasury bond rates, I think, could slip a little further, a little higher in their reach above the 8.5% level. The bond price is slipping further, resulting in perhaps an 8.75% Treasury bond. I wouldn't look for more than 1/4 point beyond what we've seen here. There's major technical support there, and I think the Fed is doing an excellent job of fighting inflation.
Would you start buying at that point, or would you wait to see the rates descending?
Long-term investors, in my opinion, should be buying in this general vicinity now, looking for an objective of about 7.25% long Treasury yields in a year or so, which would be a nice 20% return in about a year.
What's the most significant thing that could go wrong and turn you, this happy bull, into a worried bear?
Well, the worst thing that happens to the equity market long-term would be a war, militarily or socially, a huge federal spending program, or any weakening of the will of the Congress in particular to control federal spending and bring down this deficit, bring down the Treasury financing, bring down the pressure on interest rates.
Thanks very much. I suspect maybe that peace is now a better bet than congressional responsibility. Robbins, thank you very much. Thanks to our panelists. Hope you'll be back with us again next week when we'll focus on the American companies that are better known on Main Street than on Wall Street. My guest, Jack Laporte, runs the T. Rowe Price New Horizons Fund, which became a giant by investing in midgets and watching them grow. And he'll tell us which small companies he now thinks will be the titans of America's future. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been made possible by the financial support of viewers like you. By The Travelers, the company that helps provide financial peace of mind for American business. And by Prudential Bache Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. For a printed transcript of this program, send $5 to Transcripts. Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. That's $5 to Transcripts. Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Wall Street Week with Louis Rukeyser transcripts are also available to subscribers of the Dow Jones News Retrieval Service.
Events with a capital perspective. Washington Week in Review. Next at 8 on Channel 10.
Wall Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content.